I think we can start. Good morning and welcome. Just to resume something that I saw with you yesterday. Yesterday we basically started the introduction of the different sources of funding in project finance, and essentially we saw the first two basic sources of funding that sponsors can use in order to provide funds to the project. The first one was equity, and we analyzed the equity contribution agreement, but the other one is the senior debt, for which we analyzed basically either the trenching system or on the other hand, the way with which we can amortize the loan, and so the different alternatives that are used in order to depreciate the loan. For sure, you will remember that yesterday we also said that there is a third opportunity that sponsors can use in order to provide capital to the special purpose vehicle, namely the subordinated debt. And exactly what I will show you in the first part of this morning lecture is exactly why sponsors use subordinated debt and which advantages can be derived from the use of such an instrument instead of contributing pure equity. So the first part of our lecture this morning will be dedicated to the analysis of the use of subordinated loans. The second topic I would like to introduce and explain briefly to you is the problem of the so-called refinancing of project loans. I mean, particularly for projects that are successful after 3-4 years of construction. Maybe if the construction period has passed successfully, it is very likely that sponsors will require to their lenders to review the initial condition of the loan in order to, in a sense, improve the quality of the loans in terms of spread, tenor, and so duration, in order to, ask something to the lenders in exchange for a lower level of risk of the project. Refinancing a loan is very simple from an ideal point of view. The problem is that there are some technicalities that must be known in order to carefully analyze such kind of refinancing. So the second topic I would like to analyze with you today is the problem of loan refinancing. In particular, what I will show you are the different alternatives that are available to sponsors in order to refinance, to change the initial condition of the loan. We will see basically three options. The first one is the so-called waiver. Literally, waiver means a soft form of financing. It's a very light form of financing. And three basic options for hard financing. Hard financing means that the original conditions of the loan are heavily changed in favor of the sponsors. And there are basically three forms of hard refinancing. The first one is the takeover, and it is, as I told you, an hard form of refinancing. The second one is technically called the new lending, and the final one is seldomly used in Italy, but quite often used abroad, is the substitution of the original loan for a bond issue. Okay? So the original loan is closed, and in exchange for that loan, a bond issue is launched on the market. Okay? And so bond issues. But just to start this morning, let's start with subordinated loans. I told you yesterday that subordination creates different classes of loans. The base facility will become a senior loan, I mean a loan that must be paid in full in terms of interest and principal before any other loan can be repaid. Subordinated loan the word says it, is subordinated. So it is a sort of junior facility that can be repaid only when the senior facility has been paid in full. So it is a junior tranche of our debt. Being a junior debt, it is not collateralized. This is another difference. We saw yesterday that the senior facility is fully collateralized. All the assets are considered as collateral for lenders. On the other hand, since subordinated loans are provided basically by the sponsors, they have no guarantee against any asset of the project. So it is a junior debt, and usually, very often, it is unsecured. But the basic question is, why sponsors prefer sometimes to provide subordinated loans instead of equity? So the basic question is, why using subordinated loans instead of equity? There are basically two advantages of using subordinated loans in terms of instead of pure equity. And the two pros, the two advantages of using subordinated loans are very easy. The first one is very easy to understand. The financial flexibility of the project can be increased. The idea is, since I use two forms of debt, and since only the senior debt must be paid with the project cash flows in order to not be considered insolvent, important is that every year the free cash flow is sufficient to repay only the senior debt. If I'm compliant with the debt service cover ratio referred only to the senior debt, I will be considered not insolvent, and so the project can go on without any problem. If free cash flow is not sufficient to repay senior debt, I will be considered insolvent. So, if instead of using the whole amount of debt in terms of senior, I include one tranche of senior and one tranche of subordinated, I can reduce the burden of debt, and so to increase the flexibility of the loan. I repeat, important is, if you have two tranches of a senior and of a junior loan, you must be compliant only with the service of the senior debt, because junior debt will be repaid in terms of interest and in terms of capital only when the senior debt has been completely repaid. So it's a sort of capital that is provided by you. The idea is, if you have sufficient cash, you will repay either the senior debt or the junior debt. If you don't have sufficient cash, important is that you have at least sufficient cash to repay senior debt. And you can postpone the payment of the subordinated loan until you have cash and you have repaid in full senior debt. Okay? Usually the subordination, the standard subordination clause, is that the sequence of payment is as such. Free cash flow pays, first of all, capital and interest on senior. And then, if I have sufficient cash, I pay interest on the subordination. So, if cash is still available, the second payment is the interest on subordinated. And finally, once the principal on senior has been completely repaid, I can start to repay principal also on the subordinated. This is the standard subordination clause. So, interests are paid throughout the life of the subordinated, and the principal repayment of the subordinated can start only when the senior debt has been repaid in full. This is the standard clause, okay? Minus I subordinated, minus K sub. On the other hand, since project finance is very flexible from the contractual point of view, there are projects, and I have seen also from my experience as a consultant, clauses that state a different set of subordination. In that case, for example, the idea was, if I have sufficient cash flow, I will pay capital and interest based on the scheduled repayment. If I have sufficient cash, I can pay both interest and capital. And so I can start also to amortize the subordinated debt, provided that cash is sufficient. The idea, anyway, is the strict subordination. This is paid before these two items can be paid. Okay? The second advantage of using the subordinated loan is much less intuitive and refers to a classic problem in corporate finance whose name is technically the dividend trap. For Italians, la trappola dei dividendi. Dividend trap is much less intuitive, and for this reason, I would like to dedicate more time to this problem, dividend trap. What is exactly dividend trap? Just to get to be on the ball, I will ask you immediately one question. Supposed to be an Italian firm, but this holds true also for most part of foreign legislations. Suppose that you want to distribute dividends to your shareholders. Which are the limitations that the law, the Italian law, state in order to make payments available in terms of dividend to shareholders? Which are the limitations that are set by the Italian legislation in terms of payment of dividends? Put differently, when you can distribute dividends to shareholders in Italy? If you have, please, go on, go on. Don't be shy. You have an income, net income. Okay. Furthermore, not only you have, do you have net income in your profit and loss, but that income must be reduced of a 5% legal reserve that must be set aside until the legal reserve reaches the 20% of the share capital of the firm. Very simple. Okay? So pay attention to this limit. You can't distribute dividend unless you have net income in your profit and loss. This is one of the key points that I want you to keep in mind when analyzing the problem of dividend trap. Dividends are paid only when net income is available. And this is the cap amount. I mean, I can't distribute any sum of money above the cap represented by net income available minus reserve, provision for reserves. Okay? Good. So, where is the dividend trap in project finance? It is quite easy. Take, for example, the case of Cogeneration 1 project. Go back to the Cogeneration 1. Cogeneration is a big plant, and it took 4 years or more in order to have the facility completely built. Okay? After the 40 months construction period, the plant starts production. And so, after 40 months, suppose that from time 0, 40 months, from this point on, the project starts producing revenues, start operation. Since the project start operation, I can start also the depreciation of this plant. And so I can include in my profit and loss the depreciation for such a facility. Okay? So in my profit and loss, I will account for the reduction of value of the plant in order to consider the fact that the plant is on operation and it loses value as long as time passes. Okay? In the first years, particularly, if I call it 0, and this 0 for me is the commercial operating date. For the first 3 years, in most part of legislation, the fiscal rules allow sponsors to increase the value of depreciation using the so-called accelerated depreciation, in Italian ammortamento anticipato. This allows, for example, to double the value of depreciation for the first year and for the following 2 years. For example, if the depreciation and amortization percentage standard for this kind of plants is, let's say, 10%, I can, in Italy, with a simplification, to double the value of depreciation and amortization in year 1, in year 2, and year 3. So I can include in my profit and loss 20%, 20%, and 20%. It's not exactly so, but for the purposes that we want to reach is sufficient. Okay? At the very end, using depreciation and amortization with an accelerated method, we can amortize basically the plant in 3 years, 60%, plus 4 years, 10, 10, 10, and 10. I have completely amortized the plant in 7 years instead of 10 years. 10% times 10. Good. Since the value of the plant is particularly heavy, do you remember in the case we had the plant whose value was 1,100 billion liras? If you account for a 10% or a 20%, this amount of depreciation is particularly heavy in the first 3 years of operation. Okay? If you agree with this, it is quite easy now to reason in this way. Let's state and let's list all the items that will be included into the profit and loss. Into the profit and loss, not cash flows, in the first 2-3 years of operation for our cogeneration plant. So, my idea is, let's state and let's list all the revenues and costs that will be included into the profit and loss of cogeneration 1 for the first 3 years. Let's start with revenues. You remember 2 kinds of revenues, from steam and from energy. So we will have plus revenues, minus cost of raw material. Do you remember the tar? Raw material. Then I will have to pay the service fee to the O&M facility manager, minus O&M fee. Now, we are accounting the profit and loss, and so now I can include the depreciation. Okay? This is the profit and loss. So all the costs must be recorded into the profit and loss in order to get the final value of the net income. So pay attention, minus depreciation. And remember that in the first years of operation, this value will be particularly heavy, particularly relevant. This means that the value of the earning before interest and taxes, EBIT, will be heavily depressed in the first 3 years by the strong value of depreciation. This value is poor in the first 3 years because depreciation is very heavy. Okay? Now, we must account for interest payments, minus interest. Suppose for the moment that we only are using a senior loan without considering any subordination. And so we have interest on senior loan. This leads us to the earning before taxes, and then taxation, minus taxation. We get net income. Quite easy. Now, since I have included one big value of depreciation, it is very likely that this value in the first 3 years will be particularly depressed. And sometimes this value can also be negative, because the value of depreciation is so heavy that he is able to reduce at a very low level the net income available. This means that, first option, if your profit and loss closes with a loss, since you have a cap in order to pay dividend, you will not be able to pay dividend if you have cash. Second possibility, the net income is positive, but it is very low, and so the cap will be effective for that top amount. Okay? Now, the problem is, probably you are reasoning in this way, if I have a low level of income, or I have a loss, I have also a low level of cash. Not necessarily. Not necessarily. Because this is profit and loss, but cash flows reason in a very different way. Cash flows. I can build up the cash flow of the cogeneration one, starting from EBIT. I deduct all the taxation from the EBIT, minus taxation. And, guys, EBIT includes something, depreciation, that is accounted in the profit and loss, but it is not relevant for the purpose of calculating cash flow. And that's why I resum the value of depreciation to EBIT. And so this big value that is negative in terms of income is positive in terms of cash flows. Suppose that the change in working capital is 0. And it is quite true for cogeneration 1, since once the project is operating, the changes in working capital are very low. We don't have capex, because capex has been concentrated in the first 40 months of operation, so this is exactly the free cash flow. Okay? Free cash flow. Now, and this is the point. Free cash flow can be used, first of all, to repay what? I have cash, and the first items to be repaid will be interest and repayment of the senior loan. So, minus interest, look at here, minus interest, and minus principal repayment. Since we are not using subordinated loans, we only have these two items in terms of financial items. What I get at the end is the free cash flow to equity. And now the problem of the dividend trap. Look, if the value of depreciation, this one, is higher than the value of interest and principal repayment, and this is probably true in the first year of operation, because if I'm using an accelerated depreciation, it's very likely that the debt service is lower than the value of depreciation. If this is true, so if D&A, depreciation and amortization, is higher than debt service, this means that this value will be positive. And probably this value will be larger than the value of net income. Because, look, we have used the same values. Interest is here, depreciation is here, and so we are using exactly the same values for the calculation of cash flows. The only difference is, for the calculation of net income, depreciation is negative. For the calculation of cash flow, depreciation is positive. And if difference is positive, it is very likely that the free cash flow available is much higher than net income. Free cash flow to equity is higher than net income. And this is not good news for sponsors, because they are looking at the special purpose vehicle, they are looking at the cash. The cash is very abundant, but unfortunately I can't distribute it, because the value of net income is lower than the value of free cash flow to equity. This is exactly the dividend trap. You can't put your hands on the big bucks of money that the special purpose vehicle is generating. This is a classic dividend trap. Of course, the dividend trap is much more evident if the net income is negative. In this case, you can't for sure distribute anything. Okay? So, if free cash flow to equity is higher than net income, dividends are kept. And this is exactly what, in technical terms, is called dividend trap. If you are not convinced of it, I can show you an example that you have in your slides, from where you can easily see the emergence of this kind of trap. The example is this one, and it is very easy to follow. My recommendation is look at your slides and redo the calculations in order to see whether you got the point or not. I will explain you very briefly what I have done with this Excel spreadsheet. First of all, let's have a look to the characteristic of the project. The characteristics are placed on the top left-hand side. The investment amount is 4,000. It is financed with a mix of 3,200 of senior debt start originally only with senior debt. And it is financed with a combination of 3,200 of senior debt, 0 subordinated, and 800 of equity. So a ratio of 4:1. 4 parts of debt for 1 part of equity. The tax rate is 33%. The interest on senior is 8%. The interest on subordinated, it is not relevant here, is 15%. And the reserve provision every year is 5% on the net income. The first part of our exhibit show the dynamics of depreciation. Look, for example, that I use 20%, 20%, 20%, exactly as I showed you for the first 3 years, and then 10% until year number 7. So the plant will be completely amortized over a period of 7 years. I show you the value of depreciation, 800, 800, 800, and then 400 for years going from 4 to 7, and the accumulated depreciation, in Italian fondo di ammortamento. You will see that at the end of year 7, the value of the accumulated depreciation is exactly 4,000, the value of the project. Okay? Then I show you the residual book value, in Italian valore contabile, and you see that the book value at the end of year 7 is 0. The plant is completely amortized. Then, in this part of the exhibit, I show you the principal repayment. I use, in this case, a very simple schedule repayment, standard and fixed installments for 10 years, 10% per year. So, since the value of the loan is 3,200, and I amortize each year 10%, the value of the principal repayment every year is 320. I calculate the depreciation schedule of the principal repayment, and I calculate, based on the calculation I showed you, outstanding end of the previous period, interest rate times interest rate, outstanding amount previous year times interest rate time 1 year, in this case, and I calculate the value of interest expenses. Very simple, nothing new. Now, look at this part of the exhibit. This part of the exhibit shows you the value of net income, and so this is the profit and loss. Again, look, it is very close to what I show you in that part of our whiteboard. Revenues, operating costs, depreciation, calculated as above. EBIT, interest expenses, calculated as above. Earning before taxes, and net income. Let's focus on the first year. Let's focus on the first year. In the first year, you can easily see that EBIT is positive, 150. These values are assumptions taken from the business plan. Interest expenses are 256, and so you can easily see that the project closes at loss, minus 106. Losses in project finance, but also in normal conditions, can be used to compensate the future income in order to reduce the tax burden. It is literally what analysts call loss carry forwards. In Italian, riporto delle perdite. And so, I can use, for example, this value of 106 of losses in the first year and 30.4 losses in the second year to compensate the fiscal burden for all the years where the earning before taxes become positive. So I will have an amount of usable losses of 136.4 that can be used in order to compensate taxes for all the years where earning before taxes become positive. So depreciation has two great advantages from the point of view of project finance. The first one is that you can amortize quicker, more rapidly, the value of the facility, first. Second, these losses are only accounting losses, and these accounting losses can be carried forward in order to compensate the future taxes to be paid. Okay? So it's like to see in this project a sort of situation like this one. These are the first year loss, 106. The second year loss is 30.4. This amount can be used in a compensation of future taxes. And from the point of view of cash, this is certainly good news. I will pay less cash. Okay? Good. Now, let's focus again on the first year. The first year closes with a net income of minus 106. Is it possible to pay dividends this year? No. Let's see if the project is generating cash, on the other hand. And we can restart calculation by using the second part of that exhibit. So I will use again EBIT, 150. I sum the value of depreciation and I deduct the value of taxes. But taxes are zero in the first year because I am in loss, and so I don't pay taxes. So I simply resum the value of depreciation. The value of depreciation is particularly strong in the first year. And you can easily see from this part of the exhibit is bigger than the debt service, because the debt service in this year is 250, more or less, plus 320, and so basically it is 570. That is much less than 800. For this reason, although the profit and loss closes at loss, the free cash flow to equity is positive. And this is a paradox, because you, as a sponsor, would be able to get cash from your project. And this is big cash indeed. It is 374. But unfortunately, according to Italian legislation, and according to most part of legislation abroad, you can't get that money, and you can put your money on the piece of the cake. This is exactly what happens with the dividend trap. Okay? Sufficiently clear? Please.
But accelerated depreciation for Italian legislation is not included in the profit and loss because it is a tax advantage.
Yes.
Not included in the profit and loss, but it's used to reduce the income for calculating the tax.
Yes, it is exactly what I tried to show you. Basically, the accounting principles say actually the accelerated depreciation is not real depreciation. And for that reason, you reduce the value of taxes today, but you will pay higher level of taxes in the future. And so from an accounting point of view, you have to take into account the so-called deferred taxes. But this is an accounting problem, not a cash flow problem.
No, but I wanted to say that you can have also a positive net income from profit and loss, and then you can use the accelerated depreciation to reduce taxes, but you have a positive net income, and you can also...
Yes, for sure. I can agree with you. You are saying that even if I don't include the part of accelerated depreciation inside the profit and loss, I can close the profit and loss with a net profit and not a negative profit. The problem remains the same. If net income is positive but its value is lower than the level of the free cash flow, you anyway fall into the dividend trap. You have cash, but not all that cash can be paid to shareholders. It is again a problem of dividend trap. But not on the cash flows. Exactly, exactly, exactly.
With the accelerated depreciation or not?
Yeah, correct.
Yeah, because the accelerated is just fiscal.
Yes.
Like you have two profit and loss. One is the accounting profit and loss,
and the other one is the civil code profit and loss. Anyway, the problem remains the same. If, for example, you take the case of a long depreciation of the loan, for example, 12 years, let's say, and you can amortize your plant in a much shorter period. Let's say, if the fiscal legislation, without using an accelerated depreciation, gives you a percentage depreciation of 20%, and so it requires you to amortize the loan, the plant in 5 years. If you amortize the loan in 12 years and you amortize the plant in 5 years, the dividend trap holds again, because the value of depreciation will be certainly higher than the value of the debt service, and again you fall into a dividend trap. I don't know if you got it. Okay. So this is bad news for sponsors. I don't want to leave all the money there, because the alternative for us is to put this money into a reserve, and the reserve will produce a positive interest, but the level of positive interest is very low. For me, as a sponsor, it is much more important to sweep out all the cash and employ my cash for other investments. So the problem is, how can I solve the dividend trap? And the subordinated loan is one of the solutions. Why? Very simple. The dividend trap can be at least partially solved using the subordination and using subordinated debt instead of providing only pure equity capital in the special purpose vehicle. You can easily see why the dividend trap can be partially solved by using the subordination. If Stefano Gatti and Paola Piaggio are the two sponsors of a special purpose vehicle, they can decide either to provide equity or provide a mix of equity and subordination. If we decide for the second option, I am, in a sort of twofold position. One, as a pure shareholder, and so I will be paid only after all other participants are paid, but I am also a creditor, although subordinated. And if I am a creditor, I can include the remuneration of my loan here in the profit and loss. So I can include minus interest on subordinated, and you can easily see that I can capture part of the flows before arriving at the net income. Because if I am a creditor, I can be paid before net income as a bottom line of the profit and loss clauses. And this holds true also in terms of cash flow. I will not be paid only with free cash flow to equity, because if I am a creditor, I can capture part of the flows before arriving at the bottom line, because here I will read minus interest on subordinated. The final result is very easy to understand. The value of free cash flow to equity can be reduced. But this is not a problem for me. Instead, it is a great advantage because I have captured part of the flows before. And even if net income is very low, or is close to zero, it is not a problem for me because I have captured part of the flows before. I am a creditor, guys, not a shareholder. And so I have a fixed right toward the special purpose vehicle to be paid. Are you on the ball? Sufficiently clear? We can recalculate what happens in this project by using a different mix of senior debt, subordinated, and equity, and analyze the first year. The first year, we have seen that using only pure debt, I can't distribute any cash to the shareholders. Now consider a mixed position of shareholder and subordination, and let's see the payoff for the first year. It is quite easy to understand. It is exactly the same project, but look, this mix will be slightly changed. So far we have 4 parts of senior debt for 1 part of equity. Now the same project will be financed with a slightly different combination. Look, the value of the project is always 4,000. The value of senior debt is always 3,200. And the value that is contributed by sponsors is exactly the same, 800, but the mix is different. 500 subordinated loan and only 300 of equity. The first part is exactly the same because nothing changes. The value of depreciation will be the same. The depreciation of the senior loan will be exactly the same. The only difference is that I include the interest expenses on the subordinated loan. I have a value of 500 of subordinated loan, 15% per annum. 15% per annum times 500 returns a value of 75 million euros for every year of operation in terms of pure interest repayment. Since the standard subordination clause states that I will repay the subordinated only after having repaid the principal on the senior loan, you can see that here I don't have any repayment on the subordinated loan. I have only to pay for 10 years the level of interest. The profit and loss doesn't change very much. The only real difference is the inclusion as an addition, as an add-on, on the interest on subordination. And here you can see interest expenses on the subordinated loan. You see, in this fashion, the value of the earning before taxes will be lower than before, because you have included the negative value in the profit and loss. And so the net income closes at a value of minus 181 instead of the original negative value of minus 106. And it is exactly 106 plus all the interest you have paid, 75, so 181. Okay? Nothing changes also in terms of calculation of free cash flow, apart from the inclusion of the payment for the subordinated interest. Okay? So, all the values are the same. The only difference is the inclusion inside the cash flow of the minus sign on the interest of subordinated loans. You can easily see that the cash flow to equity is still positive, but slightly lower than before, 75 million euros below the original value. And my question for you is, am I still in a dividend trap condition here? Yes, because the profit and loss is negative. The cash flow is abundant, is 299 million euros. But, answer to my question, are shareholders able to capture part of the cash starting from the first year of operation? The answer is yes. How much cash? 75 million. And so the payoff for shareholders is much better off now than before. I have captured 75 because I have transformed my position from the position of a pure shareholder in a position of creditor. And so I can start capture cash starting from the very beginning. From the first year, I have the possibility to get 75. In the first option, I would not get anything. Okay? This is a solution to the dividend trap. So, the standard question that may be asked to you during your exam, which are the most important advantage of using subordination, is to improve the payoff for shareholders. A joint payoff, creditor and shareholder. Okay? And in fact, if you repeat this calculation for all the years of this project, you can easily see in this final part of the exhibit a summary of what happens in our project. Okay, look at this exhibit. Here I have tried to summarize the position of the shareholders for all the years going from year number 1 to year number 10. Please, if you can and if you have time, it is a well-spent time to return on this calculation and try to see whether you are able to reconstruct all this calculation. If you are not able, please tell me and I will send you this file. I have summarized the beginning of year equity, so the equity at the beginning of the period, the net income or the net loss at the end of each period, the 5% reserve provision, the dividends paid to the shareholders, the end of the year equity, the sum of beginning of year plus or minus loss or income, minus 5% reserve provision, minus dividend. And the payoff, subordinated plus dividend. You can easily see that in the first 3 years, I get 75, 75, and 75. This means that in the first 3 years, the dividend trap is in action. You can't distribute anything, but you can get anyway some form of cash by using the interest on the subordinate. Starting from year number 4, the dividends can be paid. The dividend trap is no more effective, and in any case, with a mix of subordinated loan and equity, I can anyway get a good profile of cash. In particular, pay attention to this profile of payoff and compare it with the original combination of pure debt and pure equity. You will see that the payoff is much worse, because for the first 3 years, I can't get anything. If we look at the pure senior, and if I look at the payoff, obviously in this case, I can only ask for the payment of dividends, because as a shareholder, I can only be repaid in terms of dividend. Look at the payoff. For 3 years, I don't see any penny from my investment. And in terms of IRR, this is certainly negative because you are postponing the future flows starting basically from year number 4 and not before. Okay? Sufficiently clear for you? Any question? Please.
A couple of questions.
The first one.
Is it right to say that we also have sort of a tax shield since our interests
fall down, increase, because you are accumulating 2 interests on the senior and on subordinated, and so I can also save in terms of taxes, because the value of net income will be lower and you have tax shield on interest. Yes? So my answer is yes. The second question.
The other one is, what is the limit on subordinated loans? Since, if I'm not wrong, shareholders cannot lend all the money to the firm.
Correct. And I will address this topic just in a couple of minutes. It is a very, it's a really intelligent question. One big advantage: if I use subordination, I can improve the payoff for shareholders. There are two drawbacks in the use of subordination, and so the financial model will tell me which of the two effects will be the more relevant of the two. The first drawback is the problem of the so-called negative equity. The second problem is the thin capitalization rules. So let's see them very briefly. I have a very important pro in using the subordinated, and the main pro is the solution of the dividend trap. There are two drawbacks, and they are easy to understand. The first one is the problem of negative equity. And it is curious, but the problem of negative equity is exactly what, in a recent consulting activity I performed for one important project for the building up of an highway, it was exactly what the counterparty include in the memory of the lawyers in order to accuse the winner of the tender offer about the presentation of that offer. He said, this guy has a negative equity, and so for the Italian legislation can go on with the project, even if the project is generating cash. So from the point of view of a finance guy, I would say, but there is no problem. The loss is only accounting, is not cash. But anyway, from the Italian legislation, you can't move on a firm with a negative equity. And why negative equity? It is quite easy to understand. If you include interest on subordination here, the value of net income will fall down further, okay? Because you are including more costs into the profit and loss. If the value of losses, given the inclusion of interest on subordination, becomes very heavy, and since in the second option, you will certainly remember that the amount of pure equity is no more 800, but has become only 300, if the value of the losses is particularly strong, in a very brief period of time, the losses cancel, burn all the equity capital. And according to Italian legislation, if losses reaches 1/3 of the original capital, you have to do basically two things. Provide new equity capital, what sponsors do not want to do, or to liquidate the firm. This is a big problem, because in the second option, look carefully at the net income of the first 3 years, guys. These are the results of the first 3 years. Minus 181, minus 105, minus 30, more or less. If you look in this part of the Excel file, you see that the sum of the three values is 316. Your equity capital is off. And you are working with a negative equity. This is not possible for the Italian legislation. And so you can solve the dividend trap, but you fall in another trap, the trap of negative equity. So, when calculating the exact amount of subordinated to be used, remember that the trap that is generated by the subordinated debt is the trap of the negative equity. And in this fashion, again, look at the payoff for the shareholders. You can see that the year-end equity becomes negative at the end of the third year. Since the sum of the losses is 316, at the end of the third year you are working with a negative equity of minus 16.2. From this point on, you can't work in the Italian context. You can't move on. I don't know if it is clear. You can't work with a firm whose value of equity is negative. And so you can opt for two different alternatives. The first one, you ask your shareholders to contribute new capital, but it is not their objective. Or, in a sense, you have to liquidate this firm, even though the cash flow, and this is the paradox, is very abundant. This machine is generating much money. Okay? Question?
So that this subordinated debt makes the project riskier. I mean, it's because if you have problems in the records, I mean, in the first line.
I would not yes. I got your point. I got your point. But it is not exactly a problem of risk, because at the very end, you are the sponsor, and you know that the cash flow is basically dedicated to the payment of the first seniority loan. So I would not consider it as a source of risk, apart of the case, obviously, when the subordinated is provided by third parties. For example, mezzanine funds or something like that. If you are the sponsor, you are well aware that you will postpone the payment until the debt service on the principal, on the, senior debt has been completely repaid. Okay. Sufficiently clear for you, the problem of negative equity? Tell me. If it is not clear, I can go back one step backward. Over there, everything is fine? Good. The second problem, but it is not a problem, it is a suboptimalization of the use of subordination, is the problem of thin cap, or thin capitalization rules. For Italian, thin capitalization means capitalizzazione sottile. What is thin capitalization? Thin capitalization rules are rules that some legislations, Italy included, use in order to disincentivize sponsors from contributing debt instead of equity. The fiscal legislation is well aware that if you substitute equity for debt, you can benefit from a tax shield, because the level of interest increases, the level of earning before taxes falls, and if the level of earning before taxes fall, you have a tax saving on that interest. Okay? It is the problem of tax shield on interest. On the other hand, the fiscal legislation is well aware that this is only a way of substituting equity with debt. The idea is you are exactly a shareholder and you are using subordinated debt only to take advantage of the possibility to sweep out some cash from the very beginning. I can leave you this possibility, but I cannot give you a tax shield on interest, because on the otherwise you would benefit from two different advantages. The first one, the cash sweep out, and the second one, the tax shield. It is not correct. It is not fair. Okay? For this problem, and this is the problem that probably is related to your second question, thin capitalization rules, I don't want to go in depth into the mechanical aspects of the thin capitalization rules in Italy, but I will simply say that thin capitalization rules state usually two aspects. The first one, thin capitalization rules very often limit the tax deductibility on the subordinated debt provided by equity holders. And so, first, there is a limit to the deductibility, limit to interest deductibility. And this limitation to interest deductibility comes into action when the subordinated debt or any other form of debt may be also a part of the senior debt, even though it is quite rare as a case, is provided by either the shareholders or they are called related parties to the shareholders. For example, a controlled firm of one of the sponsors, or a subsidiary of one of the sponsors that provides equity to the special purpose vehicle. They are related parties. Okay? Or related party for a physical person is myself, my brother, or my wife that provide equity capital inside my firm. So this limitation to interest deductibility comes into action when this lending has been provided by either the shareholder directly or indirectly by one of the related parties to one or more of the shareholders. Okay? So limitation to interest deductibility when loan is provided, when loan provided by shareholders or related parties. In our example, I didn't consider the thin capitalization rule. So my idea was to include the interest on the profit and loss and to consider them fully deductible. If thin capitalization rule comes into effect, the fiscal charge would be not lower than before because interest becomes undeductible from the fiscal point of view. In any case, this is not a major concern for the project finance because the major concern for a shareholder is to sweep out cash from the very beginning. So I can also give up the advantages from the tax shield in order to get anyway some cash from the very beginning. So in a balancement between the losing of tax shield and the possibility to take over some part of the cash, the second is certainly more important. Okay. Sufficiently clear for all? Any question? Good. And so, that said, on the problem of subordination and the use of subordination as a solution for the dividend trap, very quickly, the problem of refinancing the loans. This is actually what closes the part of the financial side of project finance. What does mean refinancing a loan? Usually, refinancing takes place in two situations. The first one is a default, and so you have to restructure the loan in order to make the project survive. Okay? So, refinancing can take place in two conditions. Refinancing. Bad situations. Take, for example, the case of Eurotunnel. Eurotunnel has been restructured 5 times in order to make the Eurotunnel, to give Eurotunnel the possibility to go on as a going concern. In this case, the major reason to restructure is basically to avoid the default. And in order to avoid the default, which are the options that you, as a lender, would use in order to try to, solve the problem of cash that is missing inside the project? Which options would you use in a negotiation with the shareholders of the special purpose vehicle? Your idea is to try to reduce the cash disbursement given by the debt service. The free cash flow is there. You must reduce the level that must be paid in order to make the project still alive for all the future years of the project life. Which options? Can you give me some suggestions? Which options? In order to dilute the debt service cover ratio. Okay, the first one, postponement capital reimbursement, or lengthen the tenor of the loan, the maturity of the loan. So the first is increase the debt maturity. Second option. In terms of cost of funding, reduce spread. Reduce spread. Third possibility. I can't lengthen the debt maturity more than a certain period, because my credit committees sometimes are able to accept 10 years, 12 years, 15 years long, but no more than 15 years. If the lengthening of the loan tenor cannot be reached, which other options? Transform your position from debt holders to shareholders. Debt to equity swap. Debt in swap. Many banks into the Eurotunnel project accepted to become shareholders of the vehicle in order to, in a sense, make this project alive and well. This is what happens when projects are not going well. In Italy, luckily enough, refinancing has so far been used when projects have been good. So the situation is not a crisis situation, but instead it is a good situation. And so in this case, the idea and the main reason for the restructuring is not to avoid default, but to improve the conditions of the loan for shareholders. Shareholders go to the original arranger and say, hey guy, now the project is performing very well. Part of the risk has been eliminated. Please come with me and renegotiate the terms in a more favorable condition for myself. And if you, as arranger, are able to renegotiate the loan, I will pay you a renegotiation fee. And so the arranger has all the interest to reorganize the loan, because if it is successful, it will get renegotiation fees for this new financial package. Okay? So the basic reason to go on with the restructuring is not to avoid default, but to improve the conditions for shareholders. And this improvement of conditions for shareholders can be improvement that I will define soft, light, thin, or very hard. And so the level of intensity of this refinancing can be different according to what shareholders exactly want to get. Let's start from the soft part. In this case, I want to slightly modify the original terms of the financing. And in this case, you can easily imagine that the work of the arranger will be much easier and much faster. In this case, we are talking about soft refinancing. The technical term that is used in order to identify the soft financing is, in English, waiver. In Italian, waiver is un emendamento, una correzione, a markup of the original contract. Soft, a waiver. In this case, when we use a waiver, the idea is to basically get some form of advantages from renegotiation. Soft refinancing.
Sir, I got to interrupt the lesson and I need to change the battery.
No problem. Just one break for technical problems. waiver. The soft refinancing means basically at reaching very simple goals. The first one, you will certainly remember that shareholders are obliged in the first year of operation to set aside cash in debt reserves. You remember, for a certain period of time, I can't get all the money, and part of the money must be set aside into the cash reserves. One objective of a soft refinancing is to allow shareholders to put their hands on the cash reserves. Okay? So, one possibility for the soft refinancing is to allow shareholders to use the cash reserve. So, the sweep out of debt reserves. In this case, one very frequently used solution is to ask shareholders or to ask other banks, different than banks of the syndicate, to provide a letter of credit as a guarantee against this withdrawal of funds. So the arranger will go on the market, will find out banks that can guarantee the amount that has been withdrawn by the shareholders, and shareholders can get all this amount by paying a fee. Okay? This is not relevant, but it is important for them because cash is there, and so they can sweep out this part of cash. So the sweep out of debt reserve can be backed up by a letter of credit. The other possibility that can be reached with a soft refinancing is very simple. One of the options reduces the spread. So I go to the arranger and say, now I pay you 125 basis points more. Please renegotiate the terms of the loan with all the other banks, and please let's reduce the term, the spread from 125 to 110, for example. Okay? So the second possibility for a soft refinancing is the reduction of spread. And the third option is, I as a sponsor say, originally we negotiated a minimum debt service cover ratio of 1.45, but the construction has passed. The first years of operations are successful. Please reduce the debt service cover ratio from 145 to 130. The difference can be captured and be paid to the shareholders. So reduction of the severity of covenants. Okay? So reduction of spread and the severity of covenants. Okay? From these simple examples, you can easily see that the financing, the refinancing is soft because two of the most important characteristics of the debt, namely the duration and the debt to equity ratio, has not changed. These are the two most important effects. Debt to equity ratio has not been increased. The situation is good now. And second, the length of the tenor has not been modified. And so, basically, soft refinancing serves only for very simple changes in the original conditions of the loan. That's why it is simply called as a waiver. Waiver means that the original arranger will contact all the members of the syndicate, will amend the contract, will include the new conditions, will sign again the terms with all the members of the syndicate, and from that point on, the loan is signed with more favorable conditions than before. But nothing has changed in terms of either the debt to equity ratio or the number of years in which I will repay the loan. Because these are conditions that define the hard refinancing. That is the second option that can be used when talking about refinancing in good conditions. So, soft refinancing is a waiver. It is quite easy to accomplish. It requires no more than 1 month and a half, and it is paid, because the arranger is paid for the refinancing, and the standard cost for a refinancing fee is between 10 and 20 basis points on the original amount of the loan. So 0.10, 0.20%. It is big money for an arranger. If I'm able to renegotiate, I can get this renegotiation fee. And this is good news for me. The situation radically changes when we are not talking about soft refinancing, but instead we want to really modify the original situation of the loan, and so we are talking about hard refinancing. Hard refinancing has a much more ambitious objective than the soft refinancing. The first one, since the project is performing very well, I can try to increase the ratio between debt and equity. If I increase the value of debt to equity, I will have additional cash that can be immediately paid as an extraordinary dividend to shareholders. And this is certainly good news for them. So the first the first important goal to be reached with another refinancing is the increase of debt-equity ratio. The second possibility is to basically increase the maturity of the original loan, and so to stretch the scheduled repayment over a longer period of time. Timing. Of debt increases. Okay? Let's explain a little bit better what does mean increase in the debt-equity ratio. Suppose to consider a project that originally used a debt-to-equity ratio of 4:1, 4 parts of debt for every part of equity, 3,200 versus 800. Okay? The situation is exactly this one. You have a special purpose vehicle, you have the asset side, and originally you have debt, 4 parts, and equity, 1 part. With a hard refinancing, the idea is to modify this debt-to-equity ratio, including a higher portion of debt that will refinance the old one, plus an additional part of debt. Okay? For example, a new capital structure of this fashion. Debt is 4.5 parts, and equity is, again, 1 part. 4.5 versus 1. Okay? In this case, let's put it in a different way. It is better to show you in this way, sorry. For example, 80%, 20%, 90%, 10%. Okay? You can easily see that if the refinancing aims at increasing the value of leverage, this old loan will be substituted for this part with a new loan. And this remaining part can reduce the contribution of the equity holder. This is cash, basically, that is provided by the new banks, and this cash can be reduced, can be used in order to reduce the contributions by equity holders. You have cash now, you have reserves in your balance sheet, and you can use your reserves to pay a maxi dividend, whose value is exactly corresponding to the increased amount of loan provided by the new pool of banks. Okay? So, if you have a new debt-equity ratio, and the new debt-equity ratio is higher than the previous one, I can use the additional cash provided by the new pool of banks in order to pay a maxi dividend to shareholders. And so shareholder can immediately capitalize this sum by taking over the cash available. So this amount will be paid as an extraordinary dividend. Okay? There are two remarks to be given. The first one, before arriving to the remarks, which are the technical forms, the technicalities of this new refinance, of this refinancing? There are two basic options that can be used. The first one is the so-called takeover technique. And the takeover is basically done in this way. A new pool of banks, this one, the new pool, is formed by a new arranger, and this pool repays in full the old pool and takes over the right toward the special purpose vehicle. I am the new arranger. I set up a new group of banks. This new group of banks give money to the original bank pool and substitute it for the new one. It is exactly a takeover. Okay? So, with a takeover, a new pool collects money and then this new money is paid to the old pool that, in this way, can leave the project before the original maturity. If, for example, Paola and her colleague want to leave the project, I can organize as a new arranger a new loan, I give you money, you are now out, you are over, and we take over the project for the remaining, for a definite number of years. Okay? In most part of legislations, this is the most frequent technique. But in most part of legislation, in order to get a complete takeover, you have to gain the consent by all the original members of the syndicate. So the original members of the syndicate, both of the two, must agree on this takeover. And particularly when the syndicates are particularly include a particularly heavy number of banks, that can be one of the major difficulties. If you have a syndicate with 150 banks, 160 banks, time required to get the consent by all of them can be one of the major obstacles for this kind of technique. Okay? But it is heavily used, particularly abroad. The second possibility, much more used in Italy, is the so-called new lending technique. For those of you who are Italians, you will find additional information on your slide. The first one in Italian is the surrogazione per volontà dei creditori. On the other hand, the second one is the surrogazione per volontà del debitore. Very quickly, I would say that the new lending technique is slightly different in this sense. In this case, it is a new pool of banks organized by a new arranger that goes on the market, negotiate directly with the old pool, and then substitute it for the new one. In the case of the new lending, it is the special purpose vehicle that goes on the market, looking for a new pool of banks, asking them, are you able to give me money? And with money, do you agree with me that I can use this money to repay the old pool? This is the willingness of the borrower, not the willingness of the creditor. Okay? So the idea is, the special purpose vehicle has in its original balance sheet the old pool of banks. I go on the market to the new pool and I ask, as a special purpose vehicle, to the new pool to provide me money, and so the special purpose vehicle negotiate with the new pool, the word say the new lending, and in the new lending agreement, it will be clearly stated that the proceeds coming from the new lending will be used to close the original position toward the old pool. In a sense, this money is used in order to repay the old pool, and in this fashion, the new pool takes over, in a sense, the rights toward the special purpose vehicle. Okay? This has basically, the substance is the same, because again, a new pool has substituted the old one for the old one. But there is a slightly different, and the difference is that, for example, if we use the Italian legislation, while in the first option I have to get the consent by all the creditors, the original creditors, in this case I don't need to have the consent by the old pool, because I simply have cash and I can repay you. So it is much quicker to be reached. It requires certainly more than 1 month, for sure. It requires usually 3 to 5 months. And for sure, since in this case you have changed radically the debt-to-equity ratio, the arranging fee for a refinancing will be much higher. It can arrive to 30 to 50 basis points. Okay? Sufficiently clear for all? The final possibility that is not so frequently used in Italy, but that has been used in the past in some of the deals worldwide, has been the substitution of the original loan with a bond issue. Okay? The idea is, and it was the idea underpinning the bridge on the Messina Strait, to do something like this one. The bridge on the Strait of Messina originally was planned to be built in around 12 years. Construction period. Okay? The problem was that 12 years is a very long time horizon for a lender. Usually credit committees accept loans for 15, 16 years, but if I can commit myself as a bank on a 15 years, it is very unlikely that in 3 years cash flow will be sufficient to repay the loans that will be used during the construction. This was one of the major concerns for the bridge on the Strait. The idea, originally, I said originally because you know that nowadays the bridge on the Strait is no more a priority big project, and so I don't know if it will never be released or not. In any case, the idea that we envisaged with the Minister of Economy was a situation like this one. Start with an original loan, and so ask banks to finance you for 12 years of construction period and for, let's say, 3 to 4 years of operation, so that they can start to be at least partially repaid by the operating cash flow of the project. This is the original loan. You will sometimes hear about it as a mini-perm structure, where perm is permanent, mini permanent. It is mini because it is referred only to a very small number of years of operation. If the bridge has been built successfully at the end of the 12th year, and if the first 3 years of operation are in line with the traffic projections that were included into the business plan, I could try to close the original loan with what? With a bond issue. Start here a bond issue. For example, a bond issue whose maturity is 60 years. "60 years is a term that is not acceptable to banks, but can be acceptable to capital markets, because there are institutional investors like pension funds or insurance companies that are chasing on the market long-term, good quality bonds. Okay? The idea is the debt service on this bond will be counter-guaranteed by two things. The first one is the flow of traffic across the bridge. So the basic source of repayment of the coupon will be the traffic. And in order to make more appealing, more sexy this bond on the market, include some form of credit enhancement. You know what is credit enhancement. There are, you have seen also in securitization, forms that can increase the level of rating of this bond. For example, a credit enhancement that was envisaged for an enhancement was the inclusion of a guarantee by ISPA, that is basically Cassa Depositi e Prestiti in Italian, that is one of the controlled firm by the Minister of Economy, and so basically a guarantee by the state. The idea was, issue the bond. The bond will be basically repaid by looking at the flow of traffic that the bridge will be able to generate. In addition to that, the Italian state, through one of the controlled firms by the Minister of Economy, whose name is Cassa Depositi e Prestiti, will guarantee the flow of coupon when the bridge will be not able to generate sufficient flows to repay the coupon. Okay? And this was the form of credit enhancement. Worldwide, the credit enhancement is provided basically by, I don't know if you have seen it with Andrea Fabbri in securitization, the monoline insurers. Monoline insurers are basically a very particular form of insurers whose basic scope is to lend their rating in exchange of a fee. The monoline will pay unconditionally when the project is not able to pay. And for this insurance, I get a fee. Okay? This is called a monoline insurer. The monoline insurer, basically, monoline insurer, special purpose vehicle, sells its rating to the special purpose vehicle, and the special purpose vehicle pays a fee. Selling a rating means that if the project is able to pay with its own cash flow, you simply pay me a fee and nothing happens. But if eventually the flows deriving from the project are lower than expected, then the monoline will unconditionally pay the creditors represented by bondholders. Okay? If you have a AAA monoline insurer, you can, for example, issue a AAA tranche of this project bond backed up by, for example, a BB or an unsecured tranche. And so tranching also the bond issue, refinancing the original mini-perm for the first 12 years plus 3 years. I don't know if it is clear for you. Okay? One final remark, and then I think we can stop. The additional cash that is provided when you re-leverage the loan is usually a subordinated loan. So if you pass from 80 to 20 to 90 to 10, the additional 10% is subordinated to the original 80%. Okay? The reason is very simple. If you substitute a new loan with a new one, in most part of legislation, you cancel the terms that can be used in order to avoid the clawback actions. In Italian, le azioni revocatorie. If a new loan is substituted for the old one, the period for be safe against clawback action restarts from zero. And only if you use a subordination, the original terms for the first loan can be guaranteed. So it is a technical problem. Anyway, the problem is if you include a new level of debt, this debt will be subordinated to the first one. Okay? Sufficiently clear for you guys? Good. I know that I have asked you more time. So it is 10:20, 10:35, we can start again. Okay? Thank you very much.